In this presentation, we will go through an example problem related to the internal service fund, recording transactions in an internal service fund. Recall that the internal service fund is a proprietary type fund. When we think about the fund types, we have governmental type funds, proprietary type funds, fiduciary funds. The governmental funds typically being the largest grouping of funds, them using a modified accrual basis method. The proprietary funds, which the internal service fund is a part, use a normal accrual basis, and they're going to be types of funds that are going to be similar to for-profit entities in that we have like customers and we have more of a normal kind of income generation process. We have goods and service typically. The internal service fund is going to be servicing internal to the government, meaning the customers are internal to the government. When we think about enterprise funds, the other type of proprietary fund, they're typically serving people outside of the government. So now we're looking at a proprietary fund, normal accrual basis, therefore, unlike the governmental funds, and they're going to have the customers of the proprietary funds will be internal, meaning other governmental units with the proprietary fund. Keeping that in mind, let's go through the items. First, we're going to record a payroll transaction. The data up top, we got the wages of the $58,400, the Social Security $4,010, and the employee payroll taxes the $17,370. We're going to record this transaction remembering that we're using an accrual basis to our worksheet on the right with a trial balance. The trial balance in order. We have the assets in green. We have the liabilities in orange. We have what would be the equity section in a for-profit organization. The net position section here being in light blue, and then the dark blue being what would be the income statement in a for-profit organization. Those temporary accounts that would close out to the equity section in a for-profit organization, closing out to net position here. Now, the payroll transaction, we're going to record as a group type payroll transaction. In other words, the entire payroll with one journal entry. We're not going to get into a lot of detail about the individual paychecks. If you want to get more into payroll, we do have a payroll course that breaks that information out. So the transaction then, we're going to record this in two journal entries. One related to the payroll journal entry, the payroll checks. The second related to the employer portion of the payroll taxes. This is how I would recommend to think about payroll in general, governmental or non-governmental. So we're going to say the wages then is going to be an expense. We're going to debit the wages just as we would in a for-profit type of organization. You'll note the term expense as opposed to expenditures because we are using an accrual basis as opposed to a modified accrual basis because the Internal Revenue Fund is an accrual-based fund, it being a proprietary fund as opposed to other funds like governmental funds. Then we're going to credit the due to the federal government, that being for the withholdings. Those are going to be the taxes that we're going to pay, but not taxes that are the taxes of the government taxes. There's theoretically the taxes of the employee. They earned $58,400. We have withheld from them the $17,370, which we are going to pay on their behalf to the government, to the federal government, and therefore we're going to increase a liability account, which will then pay off in the future. Then the difference is the cash. This would be like the net check. Now, again, we could be having multiple net checks here. You could think of this as the same type of transaction for one check, where you'd have, this is what would be on the pay stub, wages less the withholdings being broken out, typically Social Security and Medicare type of withholdings, and federal income tax type of withholdings. Okay, so if we post this out, we're going to say that the wages expense down here is going to be going up. That's the expense is increasing. Then we have the due to the federal government. That's going to be a liability that we're going to pay for the payroll taxes. That increasing. Then we have the cash. That's going to be going down. This is going to be the net paychecks that we are paying out. That's going to be the transaction for the payroll, in essence. Then we want the transaction for the employer taxes. So the employer taxes paying over and above what was taken out of the employee checks is going to be typically Social Security and Medicare that's matched. That's the employer portion of it. And so the transaction there is going to be payroll tax expense, and it's going to be a credit to the due to the federal government. So same credit as we saw in the prior transaction, but now we're going to be debiting payroll tax expense. Note the payroll tax expense only including the employer portion, because the employee portion that we withheld from them that we're going to be paying to the federal government is really payroll expense. It's part of the wages expense, not the payroll taxes to us, because it's their payroll taxes that we just have to withhold on. So if we record this then, We're going to say the payroll tax expense is going to be recorded here, increasing the expense. Once again, an expense as opposed to an expenditure, we've been using an accrual basis rather than a modified accrual. The due to the federal government then being the credit, increasing the liability as well. Then we have the office expenses. So we're going to say that we have office expenses purchased for cash, and this being an accrual method, straightforward method, we're going to just record the office expenses. Now note, we're going to say that these are minor office expenses, small office expenses, and therefore we're just going to expense them as an expense as opposed to putting them on the books as basically a supplies and then expensing them. So we're recording them, small office expense, debit the expense, credit the cash, and so we're going to say that the office expense going up in the debit direction, and of course then the cash is going down. We're overdrawn on the cash. Don't let that throw you off. Next transaction, we've got the materials and supplies purchased. So now we're purchasing materials and supplies. We're going to treat that on an accrual basis more like we would inventory, in that we're going to put it on the books as an asset, and then we're going to count them at the end of the time period and make the adjustment at that point. So we're going to put it on the books as an asset. We're going to be increasing the materials and supplies inventory, the asset account. And then we'll be increasing the payable, saying that we owe in the future. So the liability will be increasing. So we'll say that the materials and supplies account, then we're going to be increasing the asset account. Then the other side going to accounts payable, the liability account that we owe. And so we put it to the asset account here as opposed to the expense account, because we're then going to count it at the end as we would with inventory and make an adjustment related to it. Then we have the utility bills from the utility fund. So we got a utility bill. We're in the internal service fund. The utility bill, just like normal, we got one, but it's actually from another fund because that's another part of the government. So it's going to be fairly straightforward still, because we're going to debit utilities expense just like we would if it was normal utilities expense at a for-profit type of organization. But instead of crediting accounts payable as we possibly would in a for-profit organization, we're going to be crediting due to other funds, because the utility is another fund of the same government and therefore an intergovernmental type transaction. So it'll be acting just like it would, like a liability would though. So we'll be debiting the utilities expense for the consumption of utilities, and then the other side is going to go to due to other funds, increasing due to other funds. Next item, we have cash for payroll taxes. So we paid cash for the payroll taxes. You'll recall we recorded payroll. We had the payroll taxes on the books at the $24,010. We're going to be paying the payroll taxes of $21,380. So paying payroll taxes, this is a liability. We're going to take it off the books by debiting it. So we'll debit due to the federal government. That's basically payroll taxes payable. And then we're going to credit cash, paying out the cash at this point. We're paying off, in essence, Social Security, Medicare, federal income tax for the employees. This transaction, then, we're going to debit the due to the federal government, and that's going to decrease the liability. And then we've got the cash is going to be credited, and so the cash, again, overdrawn on the credit of the cash. Next item, cash paid to the utility fund. So now we're going to say, now we're going to pay off the cash that was paid for the utility service. We recorded the utilities last time just like we would if we had a bill, except that instead of crediting the accounts payable, we credited due to other funds, because the utilities fund is another part of the government. Now we're paying it off. That means we're going to credit cash, of course, for the $14,610 we're paying. The other side going to the due to other funds, a debit. Recording this, then, we've got the due to other funds. Credit here, we're debiting it, making it go down. We've got cash. Cash is a credit. We're crediting it. And then, again, it's overdrawn. We will record revenue shortly, which will increase the cash account soon. Then we're going to say we paid the accounts payable. So we're going to pay off the accounts payable. Straightforward accrual type of transaction. Accounts payable is a credit balance account, has $10,020 in it. We're going to pay it off with cash. Therefore, cash is going to be decreasing. Credit to cash, we're going to debit the accounts payable. Recording this, we see that the cash going down with the credit. Obviously, it's overdrawn still. And then the other side going to accounts payable. Accounts payable has a credit. We're going to debit it to make it go down. So the accounts payable going down, we're paying off the liability just as we would in a for-profit type of organization. Then we're going to say that we have the materials and supplies at year end of 490. This is going to be an adjusting type entry. Same type of adjusting entry we would do at the end of the period for a for-profit organization on an accrual basis. We're going to count the supplies and say how much supplies do we have left? $490 worth. We're going to adjust the supplies account then on a periodic system. The amount in supplies at this point in time on the trial balance is this 8,670. So if we take that number, 8,670 minus what we counted it to be, 490, then we got the 8,180. We need to decrease this by 8,180 to get to the 490. So if we do that, that's going to be the transaction. We're going to credit the materials and supplies by that amount. We're going to debit the cost of materials and supplies, in essence, the expense related account. So if we record that, we're going to debit the expense related account. That's going to be increasing in the debit direction. Then we're going to be decreasing the supplies account down to the physical count of the 490. Next transaction, we have charges to the general fund and the special revenue fund. So now we're going to be recording the income type of activity that's happening here. Now recall that this is a proprietary fund, so we have things that are going to be similar to basically customers. However, they're going to be internal customers. They're going to be other funds of the government who are our customers. And those being the general fund in this case and the special revenue fund, we then are going to basically bill them. You can think about this as basically an invoicing process of the other governmental entities, and the internal service fund is billing other entities. So we're going to have the due from other funds, kind of like a receivable, but of course it's a receivable from internal other funds. And then the other side being billings to departments, kind of like revenue or income. But again, that's going to be what the wording we will use in the internal service fund. So we're going to say that we have an increase then to the receivable. So we've increased the receivable. The other side going to, similar to a revenue account, the billings to departments. So that's going to be increasing in the credit direction. That, of course, will increase what would be thought of as kind of like the net income type of number. So in other words, we had 88,900 just of expenses before this. Now we've got the 77,100 minus those expenses. We still have greater expenses than the revenue. We're at a loss of 11,800. Next transaction, payment from other funds to the general fund and the special revenue fund. Let me rephrase that. The general fund and special revenue fund are now paying the internal service fund. So now we're getting cash from the internal service fund. This would be a typical kind of transaction we would think in a for-profit organization where we invoice a client, then we get payment from the clients that we invoiced in the future, cash then going up. So we're going to increase the cash. The other side you would think in a for-profit organization would be accounts receivable. The other asset then going down, accounts receivable. This time, however, we have due from other funds because, of course, the people that we're dealing with, the money's coming from other funds. So then we're going to say that the cash is going to be increasing. Here's cash. It has a negative balance. We're debiting it now. Now we're in the positive. That's nice. Cash is back in the positive here. And then we have the due from other funds at the 81,150. And we are crediting that, and we still have 5,400 left over in the account that's going to be similar to basically the accounts receivable account. Next item, we have depreciation. So we're going to be recording depreciation. This will be similar to a for-profit organization. And note, we're recording depreciation because we're on an accrual basis, even though we're in the fund accounting, as opposed to if we were using the governmental type funds, this being a proprietary type fund. The governmental type funds on a modified accrual basis wouldn't have the machinery and equipment or long-term type assets, the property, plant, and equipment type assets, the depreciable type assets, because they would only have the current assets under the modified accrual basis. Under the accrual basis being used by the proprietary funds, including the internal service fund, we do have the recording of the long-term assets here, and therefore we'll be recording the same kind of transaction we would see in a for-profit organization related to depreciation. That being a debit to depreciation expense and a credit to accumulated depreciation. So we're going to record that out. We got depreciation expense down below. We're increasing depreciation expense in the debit direction. The other side being accumulated depreciation, increasing accumulated depreciation, which of course decreases the book value for depreciation.